investment opportunity. The other thing that was on that slide is developments underway, and that's very much the case. You'll see some photos taken last week. The guys are on site. They're in the process of installing the camp and supporting infrastructure. That infrastructure will be in place by October. The mill guys will be on site in October, reinstating the mill, and we're looking at, as the slide suggests there, first gold mid-2025, so that's less than 12 months away. We're talking about commissioning that mill in June, first meaningful gold in July next year or thereabouts. The economic metrics of the project, very strong economics, and that's at a $3,500 an ounce gold price. You whack on another couple of $100 an ounce, and where we're at with spot prices, and it gets even more compelling. The mill, I said, we've bought a larger mill. No more additional costs. We'd already factored into the increased cost for a higher processing throughput in the DFS, but we've now gone and executed with a larger mill so we can go and achieve that higher production and higher cash flow. That mill's getting transported to site now. It'll be on site in September. Importantly, the infrastructure to support the mine, the camp, accommodation, office infrastructure and underground change houses, we own that now. We're in the process of transporting that to site and installing it. And then the final piece of the puzzle is the debt. So we're well advanced with respect to funding this project. There's a plus $40 million credit facility that we're finalising the terms on. We're finalising the security arrangements around those documents right now. That's the last piece. All of the loan agreements are ostensibly agreed. It's the security that we want to make sure we get absolutely right. That we'll announce the terms of that agreement later this week. It's looking like. In terms of our cap structure, roughly $70 million market cap, and I feel we're getting valued on an explorer metric. If you look at our 1.2 million ounce resource base, our 70 odd million dollar enterprise value, if you value us on a resource ounce basis, it's roughly about $60 an ounce. So on that basis, we feel we've got plenty of room to go higher. If you look at how producers are getting valued, they're getting valued at between $4,000 and up to $15,000 enterprise value dollars per production ounce, annualized production ounce. So if we hit the lower end of our production forecast for the first 12 months is somewhere in the order of 50,000 ounces, you can go and apply that metric to us, and there's significant upside to be had there. So certainly bullish. I'm biased. And as you can see from the title of that slide, we're well invested. That's not just myself, that's the rest of the board and the management team. And that's something that we've spent a lot of time working up the last 12 months, is putting in place a strong management team that can go and execute on our DFS. The funding's just about there. I mentioned we'll get the funding in place by the end of this week, early next week. Well, we've now got a team in place, and we've built this team up over the last 12 months who can go and execute and deliver on that. Now, the key points that I want to make with respect to this slide, other than the fact that we're well invested, so we've supported the business, we're well aligned with existing investors, is that we've got a strong track record of value creation in the resources space. So Paul Chapman, our chairman, he's the founding chairman and founding shareholder of Silver Lake Resources, amongst other valuable businesses he's created on the ASX. Roger Steinerprice and Paul Adams, again, have been involved in resource project and resource companies on the ASX for a long time and have a track record of delivering value for investors. From an operating perspective, the team, we've built that out over the last 12 months. The final piece of that team was Matthew O'Hara, our general manager. He joined us a couple of weeks ago. He has got extensive experience building mines in the WA gold space. I have worked with him for a long time. My brother Chris, who's our Chief Operating Officer, has worked with him previously. We know how we operate. We spent a lot of time together at Silver Lake Resources. Again, that's how the story links back to Chappie. So what Paul wants to do is build a business very much in that same vein as Silver Lake, laser focused on production, laser focused on cost, and delivering value. And that's exactly what we want to do, and we've got that experience having done it before for Silver Lake. In terms of the project itself, we've got a high-grade mineral resource, 1.2 million ounces in resource, 3 grams per tonne, a modest reserve, starting reserve. Now that reserve that was constrained based on the smaller mill or smaller processing capacity. I mentioned we've now got a larger mill that gets us up towards 600 to 700,000 tonne a year of processing capacity. That reserve will expand, will grow as we recut and put out an updated DFS in December of this year, so in a couple of months' time. But you can see where that's going. It's a very modest amount of the resource being mined. There's lots of growth opportunities within those resources, and I'll talk to those in a second. In terms of the infrastructure in the region, not only are we supported by our existing processing plant, but we've got sealed airstrips in Meeka. That's what we use to fly our crews in and out of. That saves us about $10 to $15 million of startup capital. And we've got our Great Northern Highway, which runs directly past our front gate. That's a sealed highway. That means we don't have the issues that some of those Eastern Goldfields producers had earlier this year, where they had road access cut. They weren't able to get supplies, explosives and food and the like onto site. We don't have that issue. That's an all-weather access road and a great asset for us. And then the things that I've mentioned before, things that we needed to replace and install on site to support the mine. We've gone out and bought that fortuitously. Sandfire, our friends to the north, about 100 k's to the north of us, are decommissioning their Davidson mine. We've been able to buy top quality infrastructure for cents on the dollar. So that's the last piece of the jigsaw puzzle. It's things that we didn't own, we now own, and we're in the process of installing on site. I won't spend too much time touching on the cash flow, other than very strong annualised cash flows between $50 and $100 million a year. The only dip there is in the second year when we're developing an underground mine. This is at $3,500 an ounce. You go and wind that up to $3,700 an ounce, which is where spot price is at the moment, and you go and add another $10 to $20 million free cash flow annualised onto those numbers. The final thing that I'll touch on with respect to the economics is the cost. So we're talking about a restart cost of $40 million. That considered all of the expansionary activities we need to do to the plant to get the bigger mill throughput, to get the bigger processing capacity. We didn't include any of the benefits, though. We weren't 100% certain we'd be able to secure that larger mill. We've now gone and purchased that mill. It's on its way to site. So what I'm trying to get across here, the message I'm giving you, is we've included all of the costs. Those costs won't change in this recut DFS that we put out in December, but the economics or the physical output of the project, the reserve, the production, the annualised production, all of those numbers are going to go up, and the economics are going to go up as well. So you're going to see more annualised production. We're talking about the first year of production being somewhere in the order of 50,000 ounces, and that's likely to ramp up to somewhere between 80 to 100,000 ounces in year 3 when we've got 2 underground mines feeding into that mill. And you can see the prior mill schedule was really capped, was really constrained. We've opened that up with the larger mill, and I'll talk to the resources that we're going to fit in there right now. In terms of the mill itself, I mentioned that we'd included all of the costs to put the bigger mill throughput. That's additional tankage, both at the front and back end, the cost to buy that the larger mill, but we didn't include the benefits. So that higher production run rate, the higher cash flow that we get from that higher production run rate. So the recut numbers that you'll see in December will have all of that upside captured, but no additional costs. We'd already factored that in. In terms of the infrastructure itself, very good quality infrastructure. Barely had the paint taken off it. The mill, that's a photo of the mill, was taken very recently, a couple of weeks ago. Commissioned 2013, put on care and maintenance in 2018. So it barely ran. It's in top condition, and that provides for a very modest restart cost. And then you've got a picture there of the accommodation building. So I mentioned we bought those assets from Sandfires. So this is, again, very good infrastructure at cents on the dollar. And this is a photo of the infrastructure being installed right now. So this was taken last week. You can see the 100+ person accommodation village. We've actually jacked that up to 130 persons. We bought some additional rooms to accommodate that increased underground production and the expansion to the open pits that DFS will shape. But you can see there you've got some of the buildings coming in from DeGrussa. You've got the buildings being installed. You've got the mill in the background. They'll start work on that mill, on refurbishing and restarting that mill in October of this year. The high-grade Andy Well underground mine, and then 19 k's to the southeast is our open pit mining area. So this is what you're looking at there. That was a photo of the camp up in that top corner of the slide. You're looking back down to the south, the mill and the underground at Andy Well there, and then the open pit operating area down here. Now, the first 12 months, we really wanted to de-risk that production profile. So what we've focused on is oxide open pits, So high grade, 2.5 to 3 gram open pits. Limited the technical technical complexity of the mining, make it very simple because we're in that ramp up phase. Still generates really strong cash flow and production, 50,000 ounces roughly, I mentioned in that first 12 months, but de-risks the project startup. From there, we'll expand. There's pit cutbacks at Turnberry as well as an additional underground at Turnberry, and then we ramp up the high-grade underground at Andy Well. So it's really it was a process to de-risk the physical startup of the mines and limit that risk to commissioning and ramp up of the processing plant, and then focus on ramping up the mines to fill that processing plant with high-grade underground feed. The undergrounds themselves, you can see so this is a long section through the Turnberry ore body. So that mine there, that strikes for 1.7 kilometres. That long section is this long section here. That's what you're looking at. The DFS had limited to oxide open pits, very small mining footprint. With the recut DFS, the expanded processing capacity will expand those pits, so much larger open pit mining footprint, as well as the addition of a high grade or higher grade underground mine. So this is where I'm getting to. We've got the expanded processing capacity. Now we want to fill it with that high grade underground dirt. So that's where it's coming from in support of that increased throughput. And then in terms of growing the underground, this Turnberry resource strikes, as I said, for 1.7 kilometres. It's a big deposit. It's a big footprint of mineralisation. Runs at about 1,600 ounces per vertical metre in the top 200 metres. It's very well drilled out. And that metal endowment drops off below that 200 metre mark. And that is really a function of the sparsity or the lack of drilling at depth. Really, this central part is the only area where we've really drilled extensively at depth, and that supports the underground. We've got areas that we believe that high-grade plunging mineralisation will extend at depth, and we're going to go back in there in October and start drilling that. We've just executed a drill for equity agreement with our friends at Top Drill, so they'll be there in addition to drilling out, grade control drilling the open pits to improve the productivity with the mining there. They'll be expanding or looking to expand the underground and fill that underground mine plan at Turnberry. At Andy Well, again, very high-grade mineralisation. Getting this into the mill is a priority for us because this is what's really going to drive cash flow. The first couple of years, we're really going to be focused on mining in the upper levels, so benefiting from that existing capital development. And you really see that when you look at the mine plan. This is what we're going to be mining in the first 12 months. It's really limited to those areas where we can develop off the existing decline. So it's capital light, it's rapid startup, and will generate strong cash flow. And then from there, we've got significant mine life and opportunity to go and drill out and expand that resource. Again, the resource here at Andy Well runs at about 1,500 ounces per vertical metre in the top 400 metres. None of the mineralisation is closed off. It stops at depth due to a lack of drilling. So some of these deeper drill holes, you can see the grade that we're seeing there. We expect those high-grade plunging chutes to extend at depth, and with that, resource and mine life will grow. Key to this slide is development is well underway. You saw that with the photo of site, and that is what the whole business is focused on. The next 12 months, or next 9 months I should say now, is focused on funding in the next week and then execution to get to that first gold mid-2025. That's the sole focus for us as a team. We're well invested. We've supported the business over the years, and we want to get that re-rate into the producer status and the valuation around that. That's really the focus for us as a business. So thanks very much for your time, and appreciate you all being here to listen to my presentation.